Hello everyone. Hi, welcome to the channel of Wall Street Mojo.
Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon.
Friends, today we are going to learn a topic that is on book value versus the market value. We come across to these two concepts very frequently. So let's understand what exactly this is all about. Book value and the market value are basically the key techniques that is used by the investors to value the asset classes. And those asset classes can be stocks or bonds. So book value is the value of the, we are talking about book value is the value of the company according to its balance sheet. And on the other hand, market value is the value of a stock or a bond which is based on the traded price in the financial markets. So though the market value can be calculated at any point of time, an investor gets to know the book value when a company files its earning on quarterly basis. Now, book value of the asset is strictly based on the balance sheet or books of the company. So book value is basically calculated, I'll just write over here BV, book value is basically calculated by taking the difference between the asset minus the liabilities. As simple as that. Now, this basically asset minus liability is also known as what? Shareholders equity, or it is also known as the net worth, and it can be derived by the accounting equation, which is asset is equal to bracket liability plus shareholders equity. Right? Now, let's talk something about market value. Now, when we talk about market value of any asset is assigned by the investors on that particular date. That is based on the current price of that asset traded in the financial market. So the market value of a company is calculated by multiplying the market price of the share of the share of the company with the number of outstanding shares. Okay, it should be as simple as that. So market value can vary at any point of time, and it can be more or less than the book value. Let's understand this whole topic with the help of an infographics. Let's begin. The definition: book value and the market value. Book value is the real net worth or the real worth of the asset of the company, but it's in the book based on the historical value. So it is the actual worth of the asset of the company, but in case of market value, it is defined as the maximum price. The maximum price that you need to pay which an asset or security can be bought or sold in the market. See, market value has a very thin sort of a difference. There's a thin line of difference. And when we talk about book value, it's basically historical values. Reflects is the second difference. The book value reflects the firm's equity. And over here, market value, as we all know, it's basically the current market price which is going on. So the current market price is the definition, or it is what it reflects, right? The third is basis of calculation. What exactly is the parameter that is used for calculating the book value and the market value? Book value is calculated by taking the difference between assets and liabilities. That's what we just learned. And when we talk about market value of the company is basically the number of shares of the company into the market price per share. So that is what we discussed just few minutes before. Frequency of the fluctuation. Book value, it happens periodical intervals, that is, it is infrequent in nature. Stagnation is there. Market value is very frequent. Market value fluctuates here and there, and it's not going to be stagnant. This is basically based on the historical value, book values, and this keeps on changing based on the market prices. What are the measurement bases? What are the measurement drivers basically? Book value of any asset is accounted in the balance sheet on historical cost, or the amortization cost, or the fair value. But when we talk about market value reflects the fair value or the market value of an asset. So as I told you, there is a very thin line of difference when we talk about this. So let's discuss what are the key differences between book value and the market value. So let's start, and we'll get to know something about this too in a nutshell form. Now, book value is basically the value of the asset that is reported in the balance sheet of the firm. So, and when we talk about market value is the current valuation of the firm or the asset and the ongoing price of the share in the market on which it can be bought or sold. Second, book value, it gives us the actual worth of the assets owned by the company, whereas you can say the market value is projected. I'll just write for you projected value of the firm's or the asset worth in the market. The third difference, let's get into it. Book value is equal to the value of the firm's equity. That's what we learned, firm's equity. And when we talk about market value indicates the current market price or the current market value of any firm or any asset. Next, fourth, an investor can calculate the book value of an asset when the company reports its earnings. When the company reports its earnings on quarterly basis, whereas the market value, it keeps on changing every single moment. Fifth, now book value, it basically shows the actual cost, okay, or the acquisition cost of the assets, whereas the market value, you can say, on the other hand, indicates the current market trend. So these are some of the key differences. We have few more to go. Let's talk about the sixth one. Book value is basically the accounting value. Remember this word for book value. It is basically the accounting value of any asset and is less relevant. This is less relevant at times when a company is actually planning to sell off the assets in the market. In comparison to that, market value reflects more accurate valuations of any assets during, so I'll just write over here, more accurate valuations, right, in comparison to the book value while buying and selling of those assets. Now, book value of the asset, seventh point, book value of an asset is accounted in the balance sheet on the historical cost. So I'll just write over here, it is reported on historical cost or amortized cost or the fair value. Got it? But when we talk about market value, it reflects the fair value or the market value of any asset. So after discussing all this, let me finally recapitulate the whole thing. It's a final conclusion. Market values versus the book value are widely used by the investors to value any asset class. Comparing market value versus book value for the company indicates whether the company is undervalued or the overvalued condition. So if the market value, if you can say that, if the market value is less than the book value, it implies that the stock is trading at discount. It is traded at discount or vice versa, and book value is the accounting value of any asset, and often it does not reflect the true market value at which an asset can be bought or sold. So market value provides more accurate current value as it reflects the demand and supply of any asset. So several multiple valuation techniques like P ratio, PB ratio, EV to EBITDA ratio use market value or the book value as one of the variables.
So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.